Most people think becoming a millionaire requires a massive six-figure salary, a fancy degree, or a trust fund. But that assumption completely falls apart when you look at the math. The numbers show that building real wealth has very little to do with your gross income. It comes down to exactly two factors: the percentage of your paycheck you actually keep, and the number of years you leave those dollars invested. When I first started out, I was barely making enough at a regular job to cover my monthly expenses. To break out of that cycle, I had to completely restructure how I thought about my money. This chart shows the exact system I implemented to pay myself first. Before a single dollar went to rent, groceries, or bills, a percentage of my income was automatically diverted straight into a savings and investment reservoir. Carving out that money up front was incredibly difficult at first. But by forcing myself to stick to the routine every single month, the friction disappeared, and the habit became completely automatic. Escaping the paycheck-to-paycheck trap doesn't require a sudden promotion or a massive raise. It requires setting up behavioral systems that remove your temptation to spend. Once that money is set aside, it needs an engine to grow. That engine is compound interest, where your investment returns start generating their own returns over time. We plot a steady contribution of $50 a month into an asset returning 8% annually. Over the decades, the return line curves steeply upward. By age 65, those micro-investments grow to $177,000. This massive gap is pure compounding. Because the curve gets steeper the longer it runs, giving your money decades to compound is mathematically far more effective than trying to inject large sums of cash late in life. But keeping that engine running requires a strict defensive strategy. You have to live below your means, even when your income eventually increases. As my salary went up, the temptation for a nicer car or expensive clothes was constant. Instead of giving in, I froze my living expenses and routed extra dollars into my portfolio. The math of compound interest works perfectly on paper, but it completely breaks down in reality if you lack the discipline to keep your expenses low and feed the system. Feeding the system also means putting the money in the right place. Picking individual stocks carries massive downside risk because one bad earnings report can wipe out a huge portion of your capital. This illustrates a safer vehicle, the index fund. Instead of a single stock, it spreads your money across a massive web of companies, giving instant diversification. While individual nodes might fail, the historical trend of the broader market consistently pushes upward. Where most investors fail is their own psychology. When the market experiences inevitable short-term drops, they lose patience and panic sell their assets at a loss. To succeed, you have to hold your position through those terrifying downturns. History shows that the overall market eventually recovers from crashes, rewarding the investors who stay put. Hitting $1 million net worth rarely requires complex financial modeling. It mostly requires the emotional discipline to sit on your hands and do absolutely nothing while everyone else is panicking. Beyond the stock market, the highest yielding asset you can build is your own financial literacy. Reading books, studying successful investors, and upgrading your money mindset is a continuous requirement. The formula for building substantial wealth on a modest income comes down to 3 variables. Save a strict percentage of what you earn, invest it broadly across the market, and let time pass. None of these steps work as a quick fix. Executing them requires locking in reliable daily habits and repeating them month after month for a decade or more. The one resource you cannot buy back is the clock. By delaying your start and waiting on the sidelines, you actively destroy your potential returns by starving them of compounding time. You need to start right now. Even if you only have a few dollars to spare, putting that money into the market today is critical. Escaping the rat race rarely happens through a massive lottery ticket or windfall. It happens through tiny, deliberate actions sustained long enough for the math to take over. If you want to learn the exact step-by-step methods for executing this strategy, how to practically save and invest on a modest income, subscribe to the channel and I'll walk you through it in the next video.